Hi everyone, welcome to Intelligent Investing. I'm April Tan, Chief Equity Strategist of COL Financial. The consumer sector is expected to be one of the best performing sectors for this year because of campaign spending related to the midterm elections and lower inflation. But are we seeing this so far based on the first quarter earnings results of consumer companies? To answer this question, we have the privilege of talking with COL's consumer analyst, Denise Joaquin, who will share with us what happened with retailers, restaurants, and manufacturers of consumer goods during the first 3 months of the year. Okay, so thank you so much, Denise, for joining us in the show.
Oh, thanks, April. Great to be here.
So for my first question, I'd like to ask you, how would you characterize the first quarter earnings of listed consumer companies? Would you say is it bad or, just fair?
Well, for the first quarter, earnings of consumer companies were still a bit on the softer side. We saw median earnings growth of consumer names growing by about 4.4% year-on-year. And results were largely mixed across the three different subsectors. Generally, results were in line with our expectations, though, since about 6 out of the 11 consumer names that we monitor delivered in-line results, while around 4 missed expectations and 1 actually beat our forecasts. So generally, we saw improving signs of consumer confidence, and it's likely that we might see consumer sentiment kind of bottoming out already.
Okay, so what were some of the positives and negatives that you saw during the first quarter?
So definitely, one of the key positives that we noticed during the first quarter results was that consumer companies generally still delivered steady top-line growth with median growth at around 6.7%. So, this was kind of slower compared to the fourth quarter amid the strong holiday spending at the time, but this was still pretty solid. So we noticed that actually for some names in the F&B sector, their revenue growth actually picked up from 4Q. So we thought that this was a positive development. On the other hand, a key negative that we noticed is that most consumer names actually felt the impact of higher costs that hurt their margins. So this was in the form of either higher commodity prices that hurt their GPM or higher operating expenses, or both.
And what is your outlook for the rest of the year? I mean, at least do you think that, we've seen the worst and things can only get better?
Definitely, the first quarter results were encouraging, and I think when we talk to some corporates as well, they would also say that on the ground they're noticing that, consumer confidence might be bottoming out already. And the first quarter results kind of did show that the decline in rice prices, which contributes a significant portion of the consumer basket, really provided some relief to the very stretched consumer. So definitely one of the risks that we'll just be looking out for would be the uncertainty on the tariff impact, especially for those consumer names with some exposure to international markets. Yes.
Yeah. So anyway, let's now talk about the individual companies. Okay. So let's start with PGOLD. I think it's one of the best performers among the consumer names. And the catalyst was its strong fourth quarter earnings and the larger than expected cash dividends. First quarter earnings were also quite good. Do you think that earnings growth are sustainable? And, what about the cash dividends? Are they also sustainable?
Right. So for PGOLD, they were pretty impressive since they delivered double-digit revenue growth. So, for most of the other retailers, at least in the latest batch of earnings results, that wasn't really an easy number to achieve. So I think PGOLD's strategy really is to remain price competitive, since there are a lot of new players out there that they want to defend their share from. And they're still continuing their aggressive store network expansion strategy under both the PGOLD and the SNR brands. So that's definitely bringing in growth for the company still at this point. So as for PureGold's cash dividends, I think they'll be able to maintain at least the absolute amount that we saw recently, even though their stated dividend policy is just to pay out at least 30% of their prior year's income. We've actually seen them exceed this threshold in the last few years. And there's still that focus on delivering shareholder value. And I think this should also be supported by their strong cash flow generation and, positive free cash flows that should support some increase in dividend payout going forward.
Mm-hmm. I'm just curious about the tariffs, because I was going through your reports, and I think that's one of the questions that analysts have been asking PureGold, like, are they going to be affected by the tariffs? And what about the stronger peso? Is that good or bad for them?
So it's really still too early to tell, I think, with regards to how the global supply chain will be affected by these tariff policies. But for now, I think that they'll still have some ample inventory that they can rely on. And I think management did also discuss the possibility of exploring other supplier options. But those are just things to consider for them currently.
Probably not the US, probably other Asian countries where, there's free trade with the Philippines.
Yes, I think that would be a reasonable response as well. As for Forex movements, we are to see PGOLD benefit from a weaker USD since majority of SNR's merchandise is imported.
I see. And now let's talk about Jollibee, because of course that's one of the favorites of Filipino investors. I'm just curious about the first quarter earnings because it's down, as you know, but when I look at just the revenues, they're actually quite strong. What happened there? Why were profits down?
Right. So Jollibee system-wide sales growth was still very impressive based on the latest numbers that we saw. But profits dipped due to a confluence of factors. So first, there was the higher effective tax rate they recognized. And this was because of the increased contributions for some of its subsidiaries locally, as well as from
countries with higher tax rates.
Yes,
right?
like Compose, since it's based in South Korea and the tax rate's higher there. And apart from that higher tax rates, there was also a dip in non-operating income. And apart from that, we also saw Jollibee's financing costs increase since they took out a $300 million USD bridge loan to refinance the senior perpetual securities that they redeemed earlier in January. So actually, we expected that redemption and refi to sort of have an offsetting factor in their non-controlling interest, but it seems like this was just offset as well by the higher contribution of their other minority-owned businesses. So just to summarize, even though operating profits were in line, it was the impact of a higher tax rate, higher share of non-controlling interest, as well as higher financing costs that weighed on bottom line.
I see. And earlier on, I asked you about PureGold and tariffs, and this time around, what about Jollibee? Is it affected by trade tariffs, the trade war? It has businesses in the US and China, which are the epicenter of this trade war.
Right. So I think the direct effects aren't expected to be very significant since for most of Jollibee's markets, their sourcing strategy appears very localized. It's just the uncertainty really comes from how their US businesses like the flagship Jollibee brand and Smashburger will perform if there was to be a slowdown in the US economy. So I think we also talked about the first quarter results of the large QSR chains in the US. And when we reviewed them, we did see some sort of a slowdown since consumer sentiment in the US is relatively weak, and the uncertainties on the tariff policies, caused some weakness in spending and some hesitance on their part. So I think since Jollibee is still a small player, we have yet to see if they'll be nimble enough, since they're also just not that big of a player in the US at this point. But yeah, we'll still have to monitor how they perform.
Yeah, so a lot of uncertainty there.
Yeah.
So now let's talk about MONDE. After MONDE came out with earnings, I remember its share price fell significantly because I think the headline profits were down. But do you think really that its profits were actually that bad?
No, when we reviewed, MONDE's recurring profits, their core earnings actually inched up around 1.5% year on year. So it wasn't really as impressive as the other manufacturers in the first quarter, since we did see some slowdown in its noodles business. But for us, I think the long-term outlook is still largely the same. I still expect its APAC BFB business to largely deliver earnings growth, since it's performing well and it has strong leadership in the segments it's operating in. And the favorable commodity cost environment should also be positive for MONDE. We've seen its major raw materials like wheat and sugar stay relatively subdued, and palm oil has also been correcting in recent months. So we think that should be still positive for the stock.
Yeah. So MONDE, the branded food, the predominant branded food that it has is Lucky Me, right?
Yes, that's correct.
Yeah. So
Leader there.
yeah. So they're still the leader today.
Yes.
Okay. And this time around, let's talk about URC. In contrast, MONDE fell, but URC, after disclosing first quarter earnings, its share price went up substantially. I think they saw a turnaround in the branded food business, and also the sugar business on a quarter-on-quarter basis. So I'm just curious, what do you think about the sustainability of the turnaround of these two businesses?
Yeah, I think the first quarter showed us that there was a significant turnaround in terms of top line for the domestic business, and it came from about 3 quarters of consecutive decline. So I think this was very telling of a more stable, a more constructive consumer spending environment. That should be positive for their sales outlook going forward. I think as for the sugar business, they were already able to flush out the large inventory costs. So the business should be stable moving forward. I think one of the key risks that we just like to monitor for URC, as well as the other listed consumers that have exposure to coffee, is that there's some delayed impact coming from coffee costs, since their supply contracts for coffee typically extend to more than a year.
I'm just curious, what's happening to coffee prices if you just look at the raw materials?
So I think early on it seemed to be concerns from El Nino, and then it was tight supply. So we did see some correction, but we have to see if it holds at these levels.
So prices have been trending up for the whole of 2025?
Yes, the moves were pretty extended, as we saw.
So I guess when we go to Starbucks now, the coffee is so much more expensive. They've increased it because of the super significant increase in all these coffee prices.
I think a lot of the players have to raise their prices to be able to cover the higher raw material costs.
Okay. Okay, so I think a week or two ago it was disclosed that Capital Group bought 5% of URC. I think one of the reasons for this is its cheap valuation. Do you agree? that the valuations of URC is cheap.
Yeah, I think even with the very strong performance of share price, after it surpassed expectations, at around 87 pesos per share, it's still trading at around 15.2 times 2025 PE based on our forecast. So this is still a large discount compared to our FV estimate of 112 pesos per share, and also below our target multiple of around 9.7 times.
I see. So right now it's 16 times, right?
Around
15, 16 times
Yes.
PE versus 20 really is RRHI.
Yes.
Yeah, so it bought back 22% of the company from one of its major shareholders. So, I think what's interesting about this is that it bought it at 50 pesos, which is 36% above the market price.
Yeah, quite surprising.
Yeah. But I guess, from a layman's perspective, why did they buy such an expensive price? And is that good or is that bad? Because why are you paying so much more?
Right. So I think when we first looked at it, it did seem, it seemed a big premium to the current share price at the time. But I think for a bit of a background as well, the foreign shareholder that they purchased the shares from, GCH Investments, they're a wholly owned subsidiary of Dairy Farm International. And Dairy Farm actually became a major shareholder of RRHI back in 2018 when they entered into a share swap with RRHI for their acquisition of Ruston Supercenters Incorporated. So at the time, I think the share swap was around 18 billion, and then it involved DFI owning about 18% of Robinsons at a share price of around 94 pesos per share. So in that sense, this acquisition actually is more of a value.
It's cheaper than the original acquisition price of
that's correct.
DFI, like so many years ago.
Yeah, it's a very steep discount as well.
I see. And yeah, I guess, another concern people may have is, I think they'll be borrowing some money to fund this acquisition. Like, I mean, can they actually afford to be borrowing that money? How would it affect their balance sheet?
So we estimate that their net debt position would balloon to about 29 billion from about 13.7 billion prior to this transaction. So I think their debt to equity ratio would reach around 48%. So admittedly, this is a bit higher than historical levels, but I think still within the acceptable levels within their debt covenants. So other than the value accretion that we expect, so I think in that sense, the latest transaction that Robinsons Retail entered into actually appears value accretive. And we also expect EPS to grow by around 6% this year and around 14% next year, since the higher interest expenses incurred from the additional debt that they borrow would largely be offset by the lower number of outstanding shares.
So when you say 6%, it's going to be 6% higher than your original forecast.
Yes, that's correct.
Yeah, and then for next year, it's an additional 14%.
Yeah, so very significant.
So the PE, in other words, would go down even more.
Yeah.
And the target price would go up even more significantly.
Yeah.
Yeah, okay. So I guess that, it's not something that we normally face. But I think in the US, it's very common for companies to buy back shares of companies. And what is your recommendation for these stocks, and which companies do you like the best?
Right. So we actually are buy rated for all 5 of these companies, given their attractive valuations and relatively steady sales and earnings outlook. But I think for me, I would monitor more PureGold and RRHI. I think these two names offer a balanced exposure to the purely domestic market, as well as cheap valuations. It also aligns with our top-down view that domestic spending will largely remain stable. So additionally, I think MONDE is still a very overlooked name at this point. I think concerns over its meat alternative business have largely overshadowed the story under its F&B unit in the Asia Pacific. So of its alternative meat unit in recent years has largely overshadowed the story of the company. But we have started to see some improvement in terms of bottom line results for the alternative meat unit in the UK since MONDE has been able to execute some of its restructuring strategies. And I think in recent weeks, MONDE's valuations have traded at a steeper discount compared to its peers in the manufacturing sector, as well as URC. But that said, fundamentals will have to catch up, consistent earnings delivery, and some improvement in its meat alternative unit should be key drivers for our re-rating of the stock.
And finally, what about URC and Jollibee?
For these two, since they have a relatively significant exposure as well to international markets, JFC through US and China, and URC through some export-oriented economies like Vietnam, I think we'd have to monitor still some key risks to their outlook.
Yeah, and I think even Jollibee has exposure to Vietnam.
Oh yes,
and
that's
yeah,
correct.
as you mentioned earlier about URC, it's also the coffee.
Yes.
And even Jollibee actually has a coffee business,
Yeah,
so they might
significant
also be
coffee
affected by rising coffee costs. Although during the first quarter, they did share that the margins there are still good.
Yeah, so
Yeah.
just key risks to monitor for now.
Yeah. So yeah, well, I guess for investors looking at investing in consumer names, they should focus more on the three names that you talked about earlier on, which is PureGold, RRHI, and MONDE.
Yeah, that's correct. Hopefully, we'll see a continued strong second
Performance,
quarter.
yeah. Okay, so with that, thank you so much, Denise, for sharing us your thoughts about the first quarter earnings of consumer companies in the Philippines. That's it for this episode of Intelligent Investing. If you found this discussion useful, don't forget to like and subscribe for more market insights. And remember, stay sharp, stay selective, and as always, invest intelligently.